So welcome back to My 5XYZ. Today we're going to do a 2021 recap. We're going to sum up some of the most important things in the news in the last couple of months that just kind of round out 2021 for us. And then part 2 on Friday is going to talk about 2022 and how today's video is going to affect how I choose to invest in things to at least start off the first quarter. First thing we need to get out of the way is the standard disclosure that I'm not a CFP, I'm not a CPA. I'm a long-term investor that's been investing since 2012, and I can tell you I've never done this before. And what I mean by that is I've never invested through a pandemic that's lasted 2 years. We're in a new situation from everyone. And so to say that there's going to be some expert that knows what's going to happen is, I think, a load of baloney. And so you need to just kind of read the news, figure out what the important kind of factors coming up are going to be, and make some decisions that you personally can live with, okay? If you want to go with more volatile ones, go for it. If you want to go with safer things like bonds or ETFs, perfectly fine. But when it comes down to it, you ultimately need to make an informed decision that you're going to be able to sleep with and be okay with. So the goals for this video is just to talk about 5 relevant issues in the news that kind of round out 2021 that I think are going to have future implications for next year. In part 2 of the video on Friday, I'm going to talk about how these are going to shape my investing goals for 2022 and how I'm going to try to manage some of the unknown and some of the risk. So what's changed in the end of 2021? The most notable one is honestly Omicron. I can't believe we are 2 years into this pandemic, but it was December of 2019 that we first got reports out of China about this unknown respiratory virus. And I personally was completely wrong. I did not expect this to spread. I don't know why I didn't think this was going to get bigger and become international, but I sure as heck did not expect us to be in 2021 at the end of it, still talking about this ongoing with really no end in sight. And so for me personally, whether or not it's true, I'm kind of getting to a point where we're 2 years in. At some point, I think we need to accept this might be here to stay and figure out how we get along with our lives as a new normal. I think doing standard precautions like washing your hands, wearing your mask in a crowded area, believing in science, so vaccines, and then trusting in the kind of medical treatments and algorithms we've kind of discovered and the new medications we've brought to market since all of this started. But kind of going back to Omicron, on November 26, 2021, the World Health Organization marked this variant as one of interest. The concern was that these mutations that it's undergone has made it change its way in how it behaves, meaning in how it spreads and potentially the severity of it. And so they've kept an eye on it. And the first reported case in the United States actually happened on Wednesday, December 1st. That was the first known COVID case. And the notable kind of aspects on this is actually that it was discovered in a fully vaccinated patient who traveled to South Africa as science are still kind of trying to evaluate this. I think it's just worth noting that this happened to someone that was fully vaccinated. And so that does have some serious implications, especially with how things shape up in the future with this. And so what you need to know is mutations happen with viruses, okay? As these viruses are replicating in their host, certain mutations can happen that can give it some additional function or additional bang for its buck, which means that it might be increasing its ability to infect new cells. So viruses technically are not alive. It's just something that's trying to replicate itself by inserting itself into our cells, allowing it to replicate, making new copies of this virus that can then spread to new cells and repeat this process over and over. So if you have a mutation that allows its increased ability to replicate itself or to penetrate and get past our immune system, this is concerning, especially if it's altering things like the spike protein, which the mRNA like the Pfizer and the Moderna vaccines are trying to target. So Moderna and Pfizer are mRNA vaccines, which essentially work by using mRNA, which goes into our cells, tells our cells to produce certain proteins, and these proteins function to create an immune response so your body knows that this is foreign and knows to recognize it, so that if your body then gets challenged with the virus, it knows that these spike proteins are dangerous and it has neutralizing antibodies that bind to it, neutralize it, prevent these from infecting, while our body then has an opportunity to clear this. So the way I liken it to is that think of the mRNA platform for Pfizer and Moderna as like a printing press. Think of that mRNA that it then gives to your body to start printing wanted posters. And that tells your body, hey, this is foreign. You should kind of be suspicious of this and be on the lookout for it and lock it down. And so that's what I think is really, truly awesome about Moderna and Pfizer with their mRNA vaccine. All they need to do is go ahead and change the mRNA to fit their needs for whatever mutation or spike protein that's necessary. And then they can go back to that printing press of just creating the new booster vaccine. And so this technology has honestly been around before. I think it was MERS and SARS that they've been doing testing before. So this wasn't exactly a brand new vaccine. Just the mRNA that we're using on this platform is a little bit newer. But this has been going on in terms of development and science. It's not like this was just rushed out in a year where we suddenly had nothing and then we have this vaccine. And so a lot of research, a lot of kind of clinical trials were going into these platforms for the mRNA technology before COVID even hit. And so what we need to worry about is kind of spread and severity. So if we have this Omicron, is it going to spread very quickly? And if it does spread really quickly, is it going to lead to higher rates of hospitalizations? Realistically, that's what we worry about the most. Are we going to be stressing our hospital systems? If cold and flu is coming and we're already kind of packed because of flu, packed because of the usual COVID currently, and then you add on a new variant that's going to stress already overtaxed medical system, that is going to be problematic, and that would be reason for potentially people to panic in the market. The other thing we need to worry about is how does this play out with people that have natural immunity, meaning that let's say you had COVID and you've developed your own antibodies through natural infection. How does this Omicron work? Is this going to lead to you getting COVID again? Is it going to be a similarly severe course after that? Even if you had this protective immunity, is it going to make it less severe or is it going to be more severe? That's things that you worry about with a new variant. The same thing is true in terms of vaccine immunity. So for me personally, I've gotten the Pfizer, the first two, and then the booster shot. And so the concern for me is whether or not Pfizer's actually has some protection against this, or if I were to get sick from this, would it lead to the same course as if I was unvaccinated because my antibodies that I have are not able to neutralize this, and then this virus could go unchecked. And so the effectiveness of current treatments is going to be kind of the last thing, but thankfully the corticosteroids and interleukin-6 receptor blockers, they think are still going to be effective in managing the severe cases. So hopefully it's not going to take at least this off the table. The future implications though is, like I said, I think COVID's here to stay and we need to figure out what our new normal is, okay? We're 2 years into this, we can't shut down our economy after every new variant. It's 2 years in and the education gap is real. So kids are not going to be able to handle going to remote learning for multiple years on end without serious implications in terms of education gap, but they're just psychological well-being. Kids need to interact with other kids. They need to be kind of in groups and settings where they can thrive, not being locked in at home, stuck on a computer, trying to learn for 7 hours at a day. The other thing is just like realistically, I don't think we can shut down our economy every time a new variant happens. And I don't think we can just have the markets go into a tizzy every time a new variant comes out. We're on O already. We're going to get through the whole Greek alphabet by the time this is all said and done. And so I personally think we need to start thinking of this as the new normal and how we're going to have ways to mitigate this. And like I said before, we need to just basic hygiene, believe in medicine and science. If we have the ability to do remote working and work from home, that's probably a good idea. Minimizing huge clusters and gatherings is probably a good idea, but at some point you need to have independent choice, and I'm not going to get into a political rant or anything on there, and so we're just going to move on to the next part. But that's kind of my thoughts on the Omicron. The second thing we need to talk about is inflation. So the cost of goods and services in October jumped to 6.2% over the past year, with food prices up 5.3% over the last year and energy shooting up a whopping 30%, according to the latest U.S. Bureau of Labor and Statistics report. That means overall inflation is running well above the Fed's 2% goal, and has been for a while, and the consumer price index has been ticking up month after month since May of 2020, and this is based off of a Fortune article that I'll put in the description. Another thing in the article they said was that both Fed Chairman Jerome Powell and Treasury Secretary Janet Yellen said in interviews this week that it's time to retire the term transitory when discussing the current U.S. inflation trends. What this means is that inflation is probably here to stay at least through 2022, And we need to use this information to factor how we're going to plan our investment strategies to finish off 2021, but also for 2022. The idea that this inflation is magically going to get better and start coming down despite our supply chain issues and kind of wage prices going up. I don't think how they really felt that this was truly going to be transitory, but now they've come out and said it, and so now we can all just kind of move forward with this information. So some of the things the article actually pointed out was that much of the current rise in costs is due to supply chain challenges and the rapid increase in demand that will likely ease as the U.S. continues to recover from the effects of the COVID-19 pandemic. So while hopefully this is true, this probably won't be immediately reflected in the quarterly earnings for the first set of quarterly earnings for the first quarter of the calendar of 2022. And so these supply chain issues are likely going to show up in the earnings report as well as guidance for future revenue and earnings per share. And so that's just one thing to kind of factor in when you're going into these earnings reports. Things could be potentially a little bit more volatile. I think it was Nike, I'm not sure if it was this most recent one or 2 ones back, but there were supply chain issues and that led to a big sell-off on Nike due to things that honestly wasn't too surprising. The other thing is wage growth. So wage growth has been less important as a source of inflation this year, but that may start to shift amid persistent staffing shortages. This is a direct quote from the Fortune article. And so while supply chain issues might let up, this shortage of people willing to work and the increased pay that's needed, it's going to lead to prices going up. These businesses are ultimately going to pass that kind of cost into you. And so inflation, like they said, is probably no longer transitory and it's here to stay. And so what does that mean for future implications for you and me? So if inflation is 6%, this means that I'm hoping to at least earn 6% on my returns to keep from losing the money that I have saved up. That's why you're investing in the market. That's why you might be doing crypto or gold or real estate. You're doing all these other things to try to earn money on the money that you have. So you want your money to work for you to get returns that are hopefully going to outpace inflation. But when inflation is 6%, trying to find something that's going to beat it is a little difficult. So you need to ask yourself, where can you find returns to offset inflation? So there are bonds, so you could do tips. If you don't know what tips are, you can go look below for the financial lingo and look for the one on tips. But basically you buy a bond that is going to give you an interest rate that is tied to the inflation. So whatever it is, that's going to be your interest rate. And so that's a way to just keep your money from not going down. There are other things like I-bonds. In the description, I'll leave a link, but it's around a little over 7% right now. And so that's a way that you can technically beat out inflation for at least the next 6 months, but there's some special rules with I-bonds. It's on that website. But essentially you have to hold it for 5 years if you want to get the full benefit of the interest rate. The interest rate changes on 6-month blocks. And so while it's a little over 7% right now, 6 months from now, it could be a little bit different. It finally comes to maturity in 30 years. And there's some things about it not being taxed by state, but federal tax, if you use it for certain exclusions, that's also being federally tax-free on that interest. And so read up about it. This is something you should at least be aware of to make some decisions about how you want to invest best for 2022. Other things are going to be your stocks, your ETFs, your crypto, real estate or REITs, and then some non-traditional assets. If you're wanting to do rally road, you can buy NFTs, you can buy collectibles, whiskeys, wine, different things, art. And so those things could potentially appreciate in price. Like you saw at Finance Pillow Talk, she talked about how she sold her Bored Ape and made a nice profit on it. And so those are always different things you can do, but there's always risk. Who knows when the NFT bubble is going to pop? I think these valuations are kind of ridiculous, but that's just my personal bias. Moving on to number 3. So we're going to talk about the debt limit. So on a Fidelity article, the quote says, since the end of July, Democrats and Republicans in Congress have twice agreed to extend the debt limit for a short period of time in order to avoid a default. The deadline is now set for February 18, 2022. So this is something that you should mark your calendars. Around that time, if they keep doing their usual political back and forth between the two sides, they are going to set the markets to have some significant volatility around that time. So one thing to note is in 2011, the disagreement went so far that the credit rating agency Standard & Poor's downgraded the U.S. credit rating to AA+, which is one step below the best rating of AAA, where it remains today. The Standard & Poor's cited the growing deficit and the prolonged debate as reasons for the downgrade. So the growing deficit, still growing, okay? Prolonged debate, they've kicked the can a couple of times now, so that's also going on. So what's to stop the Standard & Poor's from downgrading the US again? Why is that bad? So if credit rating is downgraded, that could significantly increase the cost of borrowing at the national level. And that's bad news for us. We don't want it to be more expensive to borrow money that we need. So one thing that's separating today's debt is, according to Fidelity, is that the past is larger than ever national debt. So publicly held US debt topped 100% of the GDP in 2020 and is expected to reach 102% by the end of 2021. So we're in uncharted territories in terms of our total debt. Unless a deal is reached to suspend or raise the debt limit, the US will be in danger of defaulting on our national debt. Okay, that is terrifying. While the right and the left are probably going to grandstand and make a spectacle, are they really going to let us default? Probably not. And that's most of, I think, the market sentiment from what I've read. But again, you got to be prepared for that volatility that's going to happen when they start grandstanding and dragging out to the last possible minute. But the implications of defaulting are severe. So defaulting would lead to cash flow basis, meaning expenditures would be prioritized and only paid as funds are received, and that could risk critical operations for the government, like investing in the military and Social Security. While people feel a special kind of way about the military, okay, investing in the military doesn't just have to be your standard warfare that you think about. I want to know that the US is protected with cybersecurity. I think that is also spending within the government, and that is something that we need to protect ourselves from so that our critical information is not being stolen or potentially hijacked. I mean, we saw SolarWinds, we saw the thing with Microsoft and China, and I personally don't want to see that keep getting worse. I don't know where we stand in terms of cybersecurity and all the developed nations, but from my understanding, Russia and China have some sophisticated ways to make our lives painful in a cyber way. And cyber responses are always tricky. Someone sends a missile at you, it's easy to know what response you need to do. But when someone's messing with you on cybersecurity, it becomes a little different. What exactly is the nuance or appropriate response? And so this is going to also be important because if we were to default, it's going to set the market on fire, okay? There'd be a huge sell-off, there'd be increased interest rates, and the value of the dollar would go down. And that's something I don't really want to deal with. So the future implications just mean, come middle of February, be careful. If you're going to be dollar cost averaging around that time, maybe you want to pause it until right afterwards. If it leads to volatile drops, then you can buy on the dip and then just continue with your dollar cost averaging. But be strategic, okay? If you know something is going to be coming down the pipeline that is going to make the market react poorly and volatilely, you might want to just wait things out an extra week before dumping new money into it. And so next thing we're going to talk about is number 4. It's concentration. So on Investopedia, one of the things I was looking up is just S&P 500. So the 10 biggest stocks make up 28.5% of the index market value. This means that investors should familiarize themselves with these 10 giant components to understand what drives the broader market. When they're talking about the market, they're talking about the S&P 500, and the top 10 include, in this order at the time of filming, was number 1 is Microsoft, 2 is Apple, 3 is Alphabet or Google, 4 is Amazon, 5 is Tesla, 6 is Meta or Facebook, 7 is Nvidia, 8 is Berkshire, 9 is JP Morgan, and 10 is United Health. This means even with index funds, okay, you're still concentrated where 10 companies make up 28.5% of that index. So your money, even in the S&P 500, is going to live and die by those 10 companies. It might not be as extreme, but those 10 companies have a huge impact on how potentially your retirement savings are going to go. So what I would say for this is the future implications on that is if you're going to use the S&P 500 to diversify, then you just need to be sure that those 10 companies aren't showing up elsewhere, or you're not taking an individual stock position in it. For me, if I'm doing the VOO to get the S&P 500, well, with F Tech, F Discretionary, and F Communications, their top holdings are pretty much Microsoft, Apple, Amazon, Tesla, and Google and Facebook. And so I'm already pretty concentrated in those companies. And so if I do the S&P 500 plus those sector ETFs that I like, I am exposing myself to those 10 companies, riding or dying based on how those companies do. And I personally am okay with it, but that's something you need to be aware of. If you are doing ETFs to get this diversification, to get something balanced, you need to be aware how much you're concentrated. And while ETFs can give you the illusion of being diversified, they can still be concentrated. And that's just one thing you need to be aware of. And the final thing is going to be tapering in interest. So I'm posting an article by Motley Fool, but one of the things was I was researching, why did Asana just tank? Why is information technology so labile when it comes to interest rates going up? So Motley Fool on their article talked about how President Joe Biden nominated Jerome Powell for a second term as the Fed chairman, and that sent interest rates higher. Okay. The other things that they talked about was higher interest rates generally means growth stocks trade lower. And so I guess that makes sense that Asana, an information technology growth stock, would trade lower and more volatilely. And then higher rates lower the value of future cash flows and ultimately lower the value of growth stocks. So that's the explanation for why that's true. So another thing was kind of looking at Fidelity about this, and one of the quotes that I came across was by Chris Zaccarelli. He's a chief investment officer at the Independent Advisor Alliance in Charlotte, in North Carolina, and said that given the uncertainty of inflation and interest rates over the next 12 months, he believes it's prudent to maintain equity exposures, but reallocate portfolios towards companies with strong balance sheets and robust pricing power and away from those that are more speculative in nature. And so for me, that brings me to the future implications for this. So the goal of investing in individual stocks is to find a company that has an intrinsic value that is hopefully below the stock price. The hope is that with time, the market will realize that it mispriced the two, and then that stock price will, sorry, I think I got it backwards, but basically you think the intrinsic value is higher, the stock price is lower, and you're hoping that the market's going to correct itself so that stock price goes to that intrinsic value. And then since you bought it at a lower stock price, you're hopefully making money on that. That's a whole concept of buy low, sell high. But figuring that out is very difficult. If someone had a foolproof way that could beat the market year over year, they'd be filthy rich. And there are some of them like them. So you got your Warren Buffett and some other kind of value investors. But by and large, for the average kind of retail investor, doing this with reliability and predictability is difficult. And so that's why my approach is dollar cost averaging into ETFs that track the S&P 500 in a few sectors. And then I'll roll the dice with some percentage of stocks to see if I can beat the market. But so while this kind of interest rate is going to go up because the Fed has signaled that they're going to be tapering, and as they kind of taper back, stop buying bonds, we're going to see interest rates start to climb up. If interest rates go up, this means that these growth companies are going to be under a little bit more pressure. So what I'd say is you need to be a little bit more selective of the companies that you put your money into for 2022. For me personally, I might stick to blue chip stocks or companies that are mature and stable, and I might shy away a little bit from some of the more speculative and growth companies. But that's just my 2 cents. And so for me, the future 2022, in the first quarter, we have some serious pressures that are going to drive up some volatility. So the first is going to be Omicron, second is going to be inflation, third is going to be debt ceiling, and fourth is tapering in interest rates. So those are the 4 things that I'm worried about when it comes to that first quarter to see how 2022 unfolds. I don't want to stop participating within the market, but I want to be a little bit more aware of the fact that I have 4 very real stressors that could cause the market to behave in ways that I'm not used to seeing after the last kind of year and a half, where I had the luxury of I could literally put money in a bunch of different companies and I could do no harm. Literally 2020, you put your money in a bunch of different things and they were eventually going to come up if you waited long enough. In 2021, this is probably still true for the first half. It started to get a little bit more dicey when we got to September and parts of October and November, and it definitely became a lot more dicey in the last week or two, not just for the stock market, but for the crypto market. And so for me, I don't know exactly what I'm going to do. I'm still trying to hash out what my strategies are going to be for 2022, but stay tuned for Friday's video where I cover that in more detail. But if you like what I'm doing, don't forget to hit the like, subscribe, maybe set the alert so you know when my next video. But I always appreciate you listening. Hope this helps. Hopefully you are going to take some time to just write out what your plan is for 2022 so that you know what you're getting yourself into. It's going to be a lot easier to stick to the script when you have it written down and you can look back to it rather than trying to come up with it on the fly when emotions are running high. But hope you have a good day. Thanks for listening.